Hello everyone, I'm Nico Martimucci, and in this channel I'm gonna teach you how you can actually make money while you make your payment the right way. Stay tuned. Hello everyone, my name is Nico, and today I want to talk about two main financial points: credit card debt and 401k. In the specific, I will show you my own situation, and I will try to explain why it is financially wrong to have money sitting on your 401k account if you also have a credit card debt. I will do this with the help of a simple Excel spreadsheet with formula, and I will show you the different options that I have in order to attack my debt. Let us begin with numbers. We all know that life happened, so it happened to me that by the end of the year 2019, I had a few credit cards max out for a total of $20,000. At that point, the average interest for those cards was around 25%. In another hand, I had a 401k account that I funded between 2015 and 2018 when I was working in North Carolina for an employer that was matching dollar per dollar up to 5%. In 2018, I moved to Massachusetts, and I was not able to move that account to my new 401k account. So my option was to move to an IRA, keep the money there, or cash out. As we know, the cash out option is a little bit tricky, since in order to do that, you will have to pay state and federal taxes, plus the 10% penalty fee to the IRS. My initial $16,900 was going to become only $12,600. Plus, I must pay additional $1,700 as a penalty for the next year's tax return. So I created this Excel spreadsheet in order to evaluate my 5 possible options. Option number 1, keep the 401k alone and make minimum payment every month to the credit card. Option number 2, keep the 401k alone and make a fixed payment every month to the credit card. Option number 3, withdraw the 401k and make a fixed payment until debt-free. Option number 4, withdraw the 401k and make a fixed payment until debt-free, and then start the saving account making the same payment as before, but to my saving. Option number 5, withdraw the 401k and make a fixed payment until debt-free, and then continue to save, making the same payment to my new 401k. Let's see the option one by one. The first option was terrifying. Because of the remarkably high interest rate, after 10 years, I will have paid a total of $43,300, including $29,300 in interest, and still have around $6,000 in debt. Considering these crazy numbers, I moved easily to the next option. If I consider this as a regular loan, and I make fixed payment of $650 every month, I will be debt-free after only 5 years, and I will pay a total of $32,300, including $12,300 for interest. I will still have my old 401k in place, but I don't know about you, but when I see that I must throw away $12,300 in order to save my 401k, I know that I had to evaluate a different option. So as I mentioned before, my 401k was $16,900. If I withdraw the full amount, I must pay $40 fee plus $3,378 for federal taxes plus $853 for state taxes. I will be able to make a payment to my credit card for $12,629. And if I continue to make the same fixed payment, I will be debt-free after only 14 months, and I will be able to pay the $1,700 penalty fee with no problem. By April 2021, I will have paid a total of $10,200, including $1,125 in interest. I will have no 401k anymore, but I can finally start saving, which brings me to the next option. If I keep the same routine, after 5 years, I will have a saving with at least $22,300. Basically, after being debt-free for 4 years, I will also have more than I had in my 401k. Not bad at all, if I can be consistent, of course. If I compare it with option 2, we see that in both cases, I must pay $32,300 for my pocket, but while at the end of option 2, I will have my original 401k untouched, that is to say $16,900, at the end of option 4, I will have no 401k, but a saving equal to $22,300, which may seem like not a big difference, but if we are being debt-free in the last 4 years, it's a big difference here. At this point, I may have one last option, but that will be depend if my employer is a company that offers 401k match, which it is. So in this case, the difference between option 2 and option 5 can be huge. Imagine having the option to pay $650 to my own 401k since my debt-free date. And imagine a dollar-to-dollar match. After only 5 years, I will have a 401k up to $44,600, based, of course, at the percentage of match that my employer gave me. It will be like I never had to pay my initial $20,000 for the credit card, since almost all the money I paid, including my initial 401k, are back to my new 401k. Of course, we cannot predict the future, and therefore I applied option 3 to my own situation. I know I will be debt-free by April next year, and only at that point I will consider the way I want to start saving for my retirement. There is something that I need you to know if you ever decide to withdraw your 401k in order to pay in full or in part your credit card debt. Do it at the beginning of the year. This way you will save more than what you need in order to pay the penalty fee that you will have to pay the following year. In any case, I will strongly suggest to any person that have a credit card debt, do not even think about having a saving or a 401k plan. The reason is quite simple. Freedom in the United States is not granted by the Constitution, but by your credit score. Think about it. Thank you, and have a good one.